Mr. Sanjeev Chadha, MD, CEO, Bank of Baroda, Executive Directors and other senior executives and all other officers from Bank of Baroda, distinguished bankers, many senior bankers who are present here, past and present, ladies and gentlemen, members from the media. I'm extremely delighted to be here among such a distinguished gathering at the Bank of Baroda Banking Conference. I wish to compliment Mr. Chadha and his colleagues for organizing this event in the physical mode and having chosen a theme which is so relevant today, that is banking beyond tomorrow. So we are not just looking at tomorrow, but we are looking at beyond tomorrow. It's a futuristic plan and banks need to move in tune with the requirements of changing times that we are living in. Given that the banking landscape is witnessing far-reaching changes in the backdrop of rapid innovation, disruption, and evolution of new business models, I believe the theme of today's conference merits very active discussion, and I once again compliment Bank of Baroda for having selected this topic for as the theme of this conference. In my address today, I propose to touch upon the current macroeconomic situation, followed by highlighting the special role played by the banks and the new trends emerging in the banking sector. I shall also attempt to highlight what banking beyond tomorrow may look like and the opportunities and the challenges that it may bring along. Let me first talk about the macroeconomic situation. I would like to focus specifically on where we stand today. We are living in very turbulent times. The continuing war in Europe and the COVID-19 pandemic have rendered the global macroeconomic outlook highly uncertain. Countries are facing unexpectedly high inflation, including food inflation, supply chain disruptions, and demand-supply imbalances in both product and labor markets. Central banks are tightening monetary policy at a very rapid pace, raising fears of imminent recession. Commodity prices have eased somewhat in June, but they remain elevated. Higher interest rates in the United States, along with increased risk aversion among global investors, have fueled safe haven demand and strengthening of the US dollar. Currencies of emerging market economies and even currencies of some advanced economies are depreciating vis-a-vis the US dollar. Consequently, inflationary pressures are building up and external funding conditions are becoming tighter, posing financial stability challenges in emerging markets in particular. Overall, the global situation remains grim amidst fluid geopolitical situation, while the war and the pandemic add to the forces of disintegration and fragmentation of the global economy. In such an environment, the Indian economy remains relatively better placed, drawing strength from its macroeconomic fundamentals. The financial system is well capitalized. Asset quality indicators have improved, balance sheets are stronger, and banks have returned to profitability. We are also seeing healthy pickup in credit demand. The external sector is well buffered to withstand the ongoing terms of trade shocks and the portfolio outflows. The recently released Financial Stability Report of the Reserve Bank highlights that the Indian financial system remains resilient and supportive of the ongoing economic revival. It also shows that banks are well positioned to withstand even severe stress scenarios without falling below the minimum capital requirement. The Reserve Bank continues to remain watchful of the headwinds and shall be proactive in taking measures as may be necessary from time to time to ensure financial stability. Recent developments in the forex market have generated intense debate, including predictions of rupee dropping to record lows as foreign portfolio funds exit India. I would like to address the issue in a balanced and factual manner, and I have attempted to be as objective as possible. First, it is important to recognize that spillovers from the global monetary policy tightening, the geopolitical situation, the still elevated commodity prices, especially prices of crude, and the lingering effects of the pandemic all coming together have become overwhelming for countries world over. Even reserve currencies such as the Japanese yen, the euro, and the British pound sterling have not been spared. Portfolio funds are selling off assets and fleeing to safe haven. Emerging market economies are particularly affected by capital outflows, currency depreciations, and reserve drawdowns, complicating macroeconomic management in these countries. Second, the impact of these overwhelming spillovers on India has been relatively modest. In fact, the Indian rupee is holding up well relative to both advanced and EME peers. This is because our underlying fundamentals are strong, resilient, and intact. The recovery is gradually strengthening. The current account deficit is modest. Inflation is stabilizing. The financial sector is well capitalized and sound. The external debt to GDP ratio is declining. The foreign exchange reserves are adequate. Third, in recognition of the fact that there is a genuine shortfall of supply of forex in the market relative to the demand because of import and debt servicing requirements and portfolio outflows, the Reserve Bank has been supplying US dollars to the market to ensure that there is adequate forex liquidity. After all, this is the very purpose for which we had accumulated reserves when capital flows were strong. And may I add that you buy an umbrella to use it when it rains. Fourth, a predominant part of the outstanding ECBs is effectively hedged. Let me elaborate. According to the June 2022, the last month's financial stability report of the Reserve Bank, the outstanding ECBs of the outstanding ECBs of 180 billion US dollars, 44% or 79 billion US dollars is unhedged. Now this includes about 40 billion dollars liabilities of public sector companies, mainly in the petroleum, railways and power sectors, which have assets with a natural hedge character. Besides, being public sector entities, their foreign exchange risk, if any, can be absorbed by the government if so required, but that possibility is highly unlikely. The remaining US $39 billion ECB represents 22% of total ECB's outstanding. Even this includes borrowings of those companies which have a natural hedge, that is earnings in foreign currencies. This would leave a small portion of the total outstanding ECB that are truly unhedged. So it is necessary to look, the so-called unhedged forex reserves in its proper context, rather than get carried away or get alarmed by what is revealed on the surface. We need to look at it deeper. We need to dissect it and look it in a manner that is objective and fair and true to facts. So that's why I'm saying that the truly unhedged portion of our so-called unhedged ECB outstandings are far too lower than the $79 billion, about which I think there has been some conversation in the recent days and weeks. Now, corporate entities eventually face a trade-off. If they hedge their foreign exposure completely, the cost of borrowing goes up and the advantage of cheaper borrowing in foreign currencies is lost. On the other hand, to the extent they do not hedge, debt servicing can go up when the exchange rate is under pressure. This has led to the concept of optimal hedge ratio, which calculates the proportion of hedging that minimizes the variance of portfolio. For India, Our internal research, that is the internal research of the Reserve Bank research team, estimates the optimal hedging ratio at 63%. In fact, this was one of the bulletin research articles which was published sometime perhaps last year. Now, taking into account natural hedges and the exposure of public sector companies, the optimal hedge ratio condition of India at the moment is comfortably satisfied in the case of the stock of ECBs, in which, ECBs in India's external debt. Due to the RBI's actions, including measures to encourage inflows, the movements of the rupee have been relatively smooth and orderly. By eschewing sudden and volatile shifts, we have ensured that expectations remain anchored and forex market functions in a stable and liquid manner. We will continue to engage with the forex market and ensure that the rupee finds its level in line with its fundamentals. I would like to reiterate that we have no particular level of the rupee in mind, but we would like to ensure its orderly evolution, and we have zero tolerance for volatile and bumpy movements. I would now like to focus and turn towards banking. Banks are special and not like any other commercial entity. They are not just custodians of shareholders' interest, but more fundamentally the trust of the depositors. Depositors are at the very core of the entire banking system. Protection of depositors' interest is paramount to a robust, reliable and stable financial system in the country. It is important for banks to always remember that the funds they deploy belong to the depositors, and this should reflect in proper risk management, governance and internal control systems. Some of these points were touched upon very briefly by Mr. Sanjeev Chadha in his welcome remarks. Banks are also expected to be permanent institutions after they obtain a license from the regulator. They are governed by sound regulatory and supervisory practices. The bigger responsibility, however, lies with the banks themselves to ensure robust governance and risk management, which are integral to the functioning of a bank. Going beyond regulatory prescriptions in terms of capital, liquidity and provisioning norms, and even exceeding them, would be a sign of good governance and robust risk management. This will future-proof the banks and enable them to fall back on their own balance sheet during situations of stress. It needs to be emphasized that while shareholders' interest is important in the business of banking, even more important is the interest of depositors. Shareholders of banks should focus on long-term profitability and long-term market valuation. This should lead investors to look at a banking entity for the value it would generate over the medium to long term. This approach will usher in a new paradigm of banking and will stand in good state for our economy. I would now like to focus on, the main theme that is preparing the banks for tomorrow, that is banking beyond tomorrow. The banking sector is going through a period of churning. The future of banking would witness a major shift in customers' choices and preferences with enhanced expectations from the banking industry. Each of the developments would present unique opportunities and challenges to the existing and newer players. It has to be borne in mind that sometimes the disruptions can be so sudden that it is impossible to anticipate them. To me, however, it seems reasonable that banking beyond tomorrow would revolve around, number one, the adoption of emerging technologies, customization of products and services, enhanced business and process automation, and number two, development of suitable business models with strong governance frameworks, better information management, changes in the mode of working, building of enhanced resilience capabilities, and more responsible societal and environmental role for the banks. Let me dwell upon the above in some more detail. The Indian banking system has undergone significant changes. The increased adoption of technology by traditional banks through self-upgradation or collaboration with fintechs is resonating with the idea of new age banking. This is leading to innovative products and services and newer business models. In this context, it is often cited that banks will face competition from fintechs, which are already making their presence felt within the financial services space. Today's customers, especially the retail customers, expect banks to provide them quick, reliable, and personalized services. Therefore, to stay relevant, banks would need to embrace newer and tested technologies for effective and timely business decision making, understanding the needs of their customers and delivering personalized services to them. Banking beyond tomorrow would necessitate significant investment in technology and organizational capability. Globally, banking is becoming more open, facilitated by availability of newer technologies and application programming interfaces, that is APIs, that allow interoperability among banks as also fintechs. This development presents unique opportunities for collaboration among various participants for faster and improved delivery of products and services suited to the customers. Unlike other developed countries, India has embraced a hybrid model where both the regulator and the market have collaborated for the development of open banking. UPI marked a watershed in the commencement of open banking in India. The success of UPI, implementation of the account aggregator framework, and the mass adoption of digital banking services, with all these, India is witnessing an emergence of new business models. More and more banks are opening up for collaboration with new age service providers for facilitating customers to make better use of their data and avail a wider and richer set of services. Now, given the digitization wave in banking world over, and with the new tech-savvy customers that we have and whose numbers are growing from day to day, banks must also strike a fine balance between digital and paper-based forms of communication. While the apps and websites of banks have grown in leaps and bounds over the years, there is still substantial scope for facilitating easy navigation for customers. Simplifying disclosures and access to information and innovative deployment of tools such as chatbots to help customers navigate through the websites and mobile applications will greatly enhance the banking experience. Financial inclusion has been pursued vigorously with steady improvements as reflected in the Financial Inclusion Index introduced by the Reserve Bank of India. In fact, we released the latest Financial Inclusion Index, and it shows substantial improvement over what we had in 2019. And 2019 itself was a substantial improvement over the previous period. Receiving digital payments such as wage payments, government cash transfers, and domestic remittances are catalyzing the financial inclusion drive. With digital technologies, while digital technologies are also offering a powerful way to overcome barriers to access banking and financial services, we also need to be sensitive to the requirements of our people to avoid any kind of digital divide. The presence of human touch in traditional branch banking would still be relevant for customers in many respects and in many areas. There is also a need for providing timely and seamless credit to agriculture and MSME sectors as a part of the focus on financial inclusion. Social media is an alternative platform for reaching millions of customers. Indians on an average spend around 2.4 hours daily on social media. Further, the number of social media users has been growing very steadily. The analysis of social media use has the potential to help banks in reviewing their strategies in terms of customer segmentation, customer acquisition, and furthering financial inclusion. Social media can also be used in customer grievance redress management. With advancement in digital banking, cybersecurity will remain an important challenge for all stakeholders. The increasing use of IT systems by banks, remote working arrangements, accelerated adoption of digital banking services by customers, along with increased dependence on third parties for various services, would warrant enhanced resilience capabilities to ensure business continuity. This would include building strong defenses against cyber attacks and malicious attempts at disrupting, disabling, or destroying a computing infrastructure or stealing confidential information and data. Banks would need to undertake constant upskilling of personnel in this regard. Continuous knowledge acquisition and staying ahead of the curve would become even more crucial in the days to come. Climate-related risks will be the focus area in times to come. Such risks will impact the business models of banks. The increased requirements of funding businesses and industry for tackling climate change would be greatly influenced by the global move on climate-related risk management. Various stakeholders already consider environmental, social, and governance, that is ESG, as an important aspect while making investment decisions. Banks are also increasingly aligning their businesses, including assessment of financing assets, with the global climate sustainability agenda. The need for banks would be to develop appropriate business strategies and strengthen the governance framework to gauge the associated risks. In line with international best practices, a forward-looking, comprehensive and strategic approach would be required to address the climate-related risks. Let me now try and conclude. Going ahead, the world of banking is expected to be more collaborative as well as competitive, with newer players offering innovative financial products. Banks need to prepare themselves for facing the dynamic environment while keeping their focus on appropriate business models, sustainability, stability, and customer centrality. More importantly, good governance remains fundamental to success and should not be compromised at any time. Due care needs to be taken to protect the stakeholders from digital frauds, data breaches, and cyber crimes. At the end of the day, banking is a service, and enhanced customer protection and experience should be given primacy it deserves. From the regulator's perspective, the Reserve Bank is fully committed to build an enabling environment for accommodating the new disruptive innovations in a sustainable manner while preserving financial stability. History suggests that when technology, market participants, and regulators join hands, revolutionary innovations and growth would follow. I hope our banks of tomorrow will make it come true, and that is precisely the essence of, that is precisely what would constitute the essence of banking beyond tomorrow. Thank you very much.